There we are. People are starting to join the room. Welcome to panel 2.2. Appreciate everybody rejoining. This has been a decent solution for us. I would say Zoom is good because everybody's on, but also then everybody's on. So this is what it is, and we'll work through it. Mandy, I'm going to turn it back over to you. Holler if you have any issues or questions.
Wonderful. Well, thank you, Todd. Again, I am Mandy Malott. I'm a business development specialist with the City of Columbus Economic Development Division, and we are here with the second half of our panel. This one, we have a commercial real estate specialist on, so we're going to get some less wonderful news, I'm sure, than Brian had to tell us about industrial in the first half. Before we begin, I just want to remind everybody that feel free to put your questions in the chat, and I will ask some of our panelists. So let's get going. First, I'm going to have everybody introduce themselves and give a brief overview of how COVID has affected their work and their sectors. So let's start with Steve.
Well, thanks, Mandy. I'm Steve Wathen. I'm founder and owner of a company called Equity. We're a full-service commercial real estate company that's headquartered in Columbus, Ohio, and we have 7 offices around the country, and we work nationally. So we have a fairly broad perspective on things. I was asked to comment primarily on healthcare, which is our predominant sector in development around the country. We do lots of medical office buildings, senior housing facilities, and surgery centers and other specialty facilities. A lot of people think of COVID as being a boost to the healthcare industry, but that hasn't been the case. It was actually the first industry hit. Even before office closures and those other orders, bars got closed, medical practices got shut down. If you recall the fear and trepidation on the initial panic that originated in New York City, it was all about hospital beds and capacity. So to free up those hospital beds and capacity in advance of anything, elective surgery was shut down and everything related to that. So healthcare really went down very fast. At least in terms of what we do, medical office buildings, places that physicians occupy and see patients, the commercial real estate side of healthcare. So in any case, you've heard a lot about telehealth picking up the slack, but most healthcare can't be performed remotely. It requires physical examination, laboratory tests, and things like that. So operating in an office was critical. So when offices started to reopen, at least in Ohio in May, the business of healthcare started to recover very quickly. And just one last comment on the effect COVID's had on our industry. Everybody that has a portfolio of real estate noticed a lot of rent didn't get paid. That was, as soon as this hit in March, it was speculated there'd be a drop off in rent receipts. And our results were similar to the nation, pretty much right on par. In our healthcare portfolio in April, we collected 74% of the rent. So 26% of the healthcare tenants simply didn't pay rent. In retail, it's a lot worse. Only 57% of our tenants paid rent. And again, those were in tune with national averages to show how that's abated. In June, 87% of our healthcare tenants paid rent, as opposed to 74% in April. And then in retail, went from 57% in April to 75% in June. And then I don't have our July numbers, but we know it improved in July as well. So it's recovering. But as you look at those numbers, you can see that healthcare, in terms of the asset class, did outperform those other asset classes. It vastly outperformed general office as well.
Wonderful. Thank you, Steve. So let's go to Zach next.
Hey guys, thanks for having me. So I'm an associate with the Patton Wiles Fuller Group, and we specialize in sale and consulting of retail assets, both multi-tenant and single tenant. And so we focus on Columbus, Greater Ohio, and then really just the entire Midwest. And so kind of piggybacking on what Steve mentioned, I mean, the effects of the retail sector were just kind of tied back to the economy as a whole. So obviously at the beginning, we had mandatory shutdowns, and I think we all felt the pain of staying home. And, a byproduct of that is a very large portion of tenants had to shut down, and obviously unemployment skyrocketed. So again, not saying anything that we don't know, but shutting down means virtually no business for non-essential brick and mortar. And so what this did is it created a strain on both tenants and landlords, and even those who had, run e-commerce channels. So for us, there was a lot of effort of just helping landlords through rent abatements and trying to figure out kind of what their next steps are to survive. The reality is not every tenant, whether you're large or small, as we've seen, have the financial runway to withstand an event like this. And so early on, we saw what's similar to what Steve said, defaults on rent. You're still seeing bankruptcies from parties, both landlord and tenant. And there's really just a downstream effect of retail and a cycle where consumers don't or can't purchase goods, tenants can't pay rent or retain employees, and then landlords default on their mortgages, or they're not pocketing as much cash, and therefore it just becomes kind of a vicious cycle. We're now kind of, post shutdown. So essentially all businesses that were forced to shut down are now operating. But the reality is in many cases, they're not back to 100% with capacity, foot traffic, or from a sales perspective. And so we're seeing the consequences from what seemed to be a full shutdown on non-essential brick and mortar. Those are coming back a little bit, but my partners and I, we focus on the sale of these type of assets. So it's a simple concept that when there's a lingering question mark on a sector, on tenants, investors feel that it affects their returns, and it absolutely does. And therefore, there's just a lot of shakeup from buyers and sellers.
Great, thank you. And finally, we'll go to Wayne.
Good morning, everybody, and thanks for having me also. I'm Wayne Hare with Newmark Knight Frank, specialize in commercial office, both represent tenants and landlords. The COVID was quite a strike to the office market. Not so much that the vacancies moved up or not, but the fact that the market was really, really hot coming into the first quarter of 2020, and about March 12th, all of a sudden everybody stopped. So now I guess we're into 5 months of the virus, and although most buildings are in good shape, because again the market was hot, what I've been tracking lately is the sublease market, and right now, subject to change, 15 buildings, or 15 spaces, I should say, have come up over 10,000 square feet for sublease. The biggest so far, I think, is the Alliance Data System building at Easton, 240,000 feet. And there's probably going to be more, and large companies, iSource, Grange, companies that are very familiar to Central Ohio, have put space on the market to try to get to offset some of their losses, or people not occupying their spaces, I should say. The question will be who's going to take those spaces when everybody's putting sublease on the market. So should be interesting. I maintain the optimistic view that once we get a vaccine, people will be back to the offices. And I don't know about what everybody else is seeing, but I've seen a lot more people on the golf courses these days than I'm working. So I don't know about work from home. That's still a debate that we could probably talk for a couple hours on. So anyway, if nothing else, it's interesting.
Thank you. So since I have the three of you who have a broader view than just the Central Ohio market, I wanted to ask, how are you guys seeing Central Ohio performing in your sectors compared to the state and the country?
I can take
Steve,
it.
why don't you go first?
Sure.
Go ahead, Steve.
Thanks, Manny. Thanks, Wayne. Again, we have offices in 7 cities there. The offices outside Ohio are in Texas and Florida. If you followed the news on COVID, Florida and Texas haven't done real well. And Ohio, if you compare us to everyone else, we've done very well as a state. And it's enabled us to keep offices open, to not have to claw back any of the restrictions from March that were released. So generally, I see Central Ohio as, relatively speaking, strong. It's obviously not strong compared to, as Wayne said, the beginning of the year or even the last 5 years in a row, but it seems to be coming back very quickly in our view. As I said, in the healthcare sector, everybody's back to work. Necessarily, most healthcare is not optional, right? You have to go. Retail's optional. You can choose whether you go to a restaurant or not. But if you're sick or you broke your leg, you're going to go get medical attention. So healthcare is regaining ground very quickly. And again, I've just seen better results in Ohio, and particularly Central Ohio, than I have our other markets. I'm very bullish on Columbus and where we're headed through this thing.
Great. Wayne, why don't you jump in?
Well, I mean, again, the market was very, very warm. It was busy. People were calling, want to take more space. They were hiring. The unemployment rate was what, 3-4%. So people were knocking down space pretty consistently. And again, when they shut the faucet off, all of a sudden now everybody wants to put space on the market. I'm going to go back to the hopefully a vaccine by, maybe first of the year, plus or minus, hopefully, that people will want to come back to the offices, because you have 3 or 4 things that'll, drive that. One is recruiting. Hey, I got a new office in the Short North or the Arena District or in Easton or wherever, and it's pretty cool offices. You got a lot of amenities. I mean, that's what we were selling before. And then, that culture that can be created, that communication. So say you're on a real estate team of 3 or 4 people, a couple brokers, a couple assistants, whatever. It's a lot easier to communicate in a conference room and set the agenda than it is coordinating times and Zoom calls and everything else. Or I can walk outside my door and say, hey, Joe, why don't we get together on this lease or whatever. It's just a lot tougher, in my opinion, to keep that communication, that culture going. So again, I'm very optimistic that 21 will be a lot better than 20. How about that?
Great. And Zach, how are you seeing Central Ohio against the state and the nation?
Yeah, so in the retail world, I mean, before COVID, obviously Columbus saw immense growth. We had very low vacancy rates, and the rents across the board are healthy, but they're not outrageously high. So from both perspectives, Columbus is just a very steady market, and we're unique because we have very strong demographics. So we don't necessarily see the highs and lows other markets see. So, during the shutdown, I think it didn't matter where you were. I mean, I think everyone saw the same backlash, and everything was just bad across the board. It didn't matter what state you were in or what city you were in. But it seems like we've bounced back quicker just because we're just kind of, Midwest steady. So, so far since we've opened back up, there's not been a whole lot of disruption. You haven't seen a crazy amount of space hit the market and kind of defaults and whatnot. But, on the investment sales side, it seems like the investors that we're working with, from California to Florida to New York, they want to get into Columbus. They want, there's been like a trend in the past few years where people are getting out of major markets and trying to come to the Midwest and these steady markets. And I think this will solidify that even further. So I think a bounce back will be pretty steady and pretty quick relative to some other areas.
Great. What kind of, and this is for Zach, but also for everybody else, one of the things that we've been seeing more in our market is these multi-use projects. You think about the new urban campus at Easton or the Gravity Project in Franklinton. Do you see that continuing to be a trend? Do you see retail continuing to be a big portion of those projects? Or do you think that there's going to be a change in this mixed-use development world?
I think mixed use is the future of retail on a mass scale. I mean, at the end of the day, there's always going to be strip centers, power centers, community centers, grocery centers. But people want an experience, across the board. Everyone wants to, if they're not going to shop online, if they're not going to do Amazon, they need something more than just stopping in and grabbing their product and leaving. So a product like Polaris, like Easton, like some of these newer developments, that's really what's going to continue to thrive. I don't personally dabble into the office market, but like Wayne said, it's a little concerning on the sublease side, but I'm sure people will kind of flock to those mixed-use developments, for office space. So I see that as a long-term trend. I don't see that changing. Maybe development will taper off a little bit more. Maybe there won't be as much product, but I think that's where everything's heading.
Wayne or Steve, do you have anything you want to add to mixed use?
Just a couple things. I think it'll come back. Also, I guess this issue of the sadness downtown is not only the virus, but then you had the protests going on and some vandalism, whatever you want to call it, in downtown was just very, very hot. New apartments, new restaurants, et cetera, et cetera. But if you go down 4th Street or High Street, even in the short north, it's coming back, but coming back slowly. And to see some of these places boarded up and places closing at 10 o'clock or whatever, it's kind of a little bit frightening right now. But again, over time, I think we'll get back there. The question is, how quickly. And I think that all comes to a head when we get a vaccine and people can feel comfortable going out and mixing it up with other people and going back to the offices, et cetera, because I'm sure the lunch crowd downtown maybe is a quarter of what it was, if that. So some of these restaurants are really struggling. And I don't know what Zach's seen, but some are really struggling. And of course, the PPP loans have kept them alive for a while. And the question is, will they keep them alive until we get a vaccine? So that remains to be seen.
Yeah, and I would add, Mandy, that to your question specifically, mixed use, I think, will continue to be the desired path for most of our uses: office, multifamily, and medical office. People desire to work in environments like that. In his earlier commentary, Wayne mentioned the amenitization, and it's huge. And the amenitization works for the people who are in those offices. Very, very desirable, walkable, to have resources, food options, and all those things, fitness facilities downstairs from where they work. But likewise, it works for the retailer, and I think retail presence. You won't see a lot of Easton scale projects, but you'll certainly see strong retail going into all those mixed use projects. The thing they get out of it is a lot of daytime population that's immediately accessible to their restaurants and their other facilities. So yeah, I think mixed use it has been the thing, and it's going to continue to be the thing well into the future. And I think, just speculating, that coming out of COVID, as that sublease space does start to absorb, people are going to pick those most desirable options, and I think most of that will occur in mixed use developments.
From that standpoint of seeing mixed use as the future and the way that most developments will likely be designed, how is the market right now and interest right now in investing in new projects, and how do you see that rebounding in 2021, 2022?
Are you talking about the investment, people buying?
Yeah, investment in buying, rehabbing, creating new projects, just that interest in new projects and not just the existing vacant space.
Right. I'll try that one. I think the people are still interested. There's a few groups who just went to the sidelines and said, with everything going on, I'm going to just take a time out and sit back for 6 or 8 months or a year, whatever, and then come back to the market. But still seeing some strong demand for people to buy offices. Some of the towers downtown have traded. One, Columbus, actually it's probably closed right before the pandemic. 65 East State is in contract. Some of the suburban buildings, again, well positioned buildings that have good traffic, good absorption, are being looked at by investors. So I see that coming back. Columbus is still a market for investors on the office side, a young, educated workforce, some growth. So again, Columbus is still on the radar as a second or third tier city, and I think that'll come back again in 21 or beyond.
Mm-hmm.
But yeah, I would add, Mandy, that in healthcare we do a lot of transaction work, both acquiring medical facilities and selling those that we develop or acquire and add value to. And in healthcare, it's kind of run unabated. The real issue in acquisition and disposition of real estate right now is the financing. It's not finding willing buyers and sellers. It's really the capital markets are still relatively screwed up. I would say, the most difficult in our whole plethora of commercial real estate activities. Debt capital is the most difficult COVID-related issue we have right now. Banks seem inordinately skittish, given that this is a relatively short-term phenomenon, vastly different than the Great Recession, which went on for years. And they're not coming back real fast. They're coming back very slowly. But we're still, again, trading medical buildings. We're seeing cap rates have stayed down low. We just went in contract on a deal, sale at 6.2 cap. We had one transaction fall out that went in contract before COVID. The buyer got skittish. It was back in contract with an institutional buyer at the same cap rate within a week. So plenty of demand there, plenty of investors looking for yield and steady yield in uncertain times with the market fluctuating so much. So at least in healthcare, the transaction market hasn't really been affected other than debt capital.
And Zach, do you have anything that you want to add on the transaction market for the retail sector?
Yeah. Do you want it more geared towards the mixed use or just retail in general?
Dealer's choice.
Okay. Yeah, so retail, there's so many sectors within retail. You've got single tenant net lease, you've got strip centers, grocery anchored centers, power centers, and malls. So as far as single tenant deals go, you got your, dollar stores, drug stores, quick service restaurants like Taco Bell, or like a, grocery like Kroger. That's actually boded very well. It seems like the cap rates on those have actually held steady, in some cases even gone down, become more aggressive because, again, it's seen as a safer investment. They were open during the crisis, and that's kind of what we're seeing moving forward. And so that kind of market is moving well. We're seeing the same dynamic with well-located strip centers with good tenants. And generally speaking, those deals are kind of a lower price point. Those are anywhere from, 1 million to 5-6 million on the high end. And similar to what Steve said, the debt market, that's kind of the biggest factor right now. There's definitely people looking for large product right now, but once you get into the power centers, these larger ones, there's just really not much lending available. Unless you want to go with a bank or credit union, which at that point it's recourse. So not many people want to, put their life on the line on that sense. But there's, again, kind of a long way of saying, like, there are some sectors of retail that are doing very well and others that are not. And there's just kind of a flight to quality right now.
Great. We have 5 minutes left. So if anybody out there wants to throw a question up in the chat, otherwise I will continue asking my questions while I wait to see if anybody has anything up. Just the fact of COVID and the fact of social distancing has changed how everybody deals with their clients. So are there any innovations that you guys have put in place, marketing or client relations wise, that you think have worked really well and you will continue after COVID has ended? I don't know, Wayne. Yeah.
Well, I've seen a couple different scenarios. I've seen law firms who will send various practices in 1 week and then home for the next week, or they'll rotate those practices. Our office is, I'll say, dribbled back in. Phase one was about 6 or 7 people. phase 2, hopefully probably right after Labor Day, bring in another 5 or 6, and then phase 3 hopefully would be the whole office. There was a lot of talk about social distancing and rearranging the whole floor plan. And although that I haven't seen that on a grand scale, we've talked about it here where, okay, if they're cubicles, they got to be so many feet apart. Offices, every other one, or depending on how big or far apart the offices are. So, we've seen stuff like that talked about. I really haven't seen, I really haven't seen it in, I guess, in physical, in practice, I guess. A lot of talk. But other than the talk, I've seen people doing it, but I haven't seen it myself. So there'll be things like that that'll probably come out of this. Again, I go back to people who got to communicate on teams or marketing teams, getting that communication going. There may be a group on some of these large companies who maybe they're data entry people, or somebody who can sit in a computer at home and work 8 hours that way. There may be that may happen, but anyway, I just haven't seen it, and I'm thinking that when things get back to normal, I guess hopefully it will be back. People will be back in the office and working the way we used to.
Looks like we lost our moderator. Does anybody else want to jump in on that question?
Yeah, I'll just add real quick to what Wayne said. We've seen all the same things in general office. Wayne, that you mentioned, healthcare is significantly different. As you can imagine, healthcare facilities are already set up for all the things that seem to be special requirements in general office. When you go to the doctor, if you're ill, you're isolated from the well patients. In good times, in normal times, you go into a private exam room that's been sterilized right down between patients. So medical practice, they've had to do some new things, but not a lot of new things. The other thing you see differently with our healthcare clients versus other types of general office, the healthcare clients generally aren't, the fear and trepidation isn't there. They're healthcare professionals. They see illnesses worse than COVID every day. And not that COVID's a gentle illness, it's a horrible thing. But the point is that's what they're trained to deal with. So again, we haven't seen the fear among those clients that we've seen among general office and retail customers. So they got right back to work as soon as they were allowed to, and leaned into it. And they're doing what they can to help with COVID, which is not what most of them do. But they haven't had really any issues opening up their offices.
Wonderful. Well, let's see. I'm seeing Todd again, so I'm guessing this is the end of our panel. I want to thank Wayne, Zach, and Steve for joining us today and giving us such great insights, and hope everybody has a great morning.
Likewise, great panel. Way to go, everybody. Great information. If you're watching online, meet us back or go back to the lobby. We got our last panel coming up. We're going to finish strong and be out of here by noon. So we'll see you all in a few minutes. Again, back to the lobby. Find the panel 3 link. Click on it. We'll see you here. Thanks, everyone. Great job.
Thank you.
Thanks for having us, guys.
Thank you. Thanks, Mom.